Cash flow, £100. Capital growth, £500. 10% returns, ROCE, yields, combined returns. What is a return on your investment and how much should you be looking for? First thing you need to be deciding is, where are you getting your profit center from? What does that mean? Well, a lot of people, when they go into property, what they think about is the cash flow, i.e., I put this amount of money in, how much am I getting in on a monthly basis? And I think that's okay, by the way, but you need to be really clear on your strategy. So, for example, if your number one focus is how much cash flow you get, getting a boring vanilla buy-to-let property isn't going to be for you. Maybe you want to think about serviced accommodation or rent to SA, whatever you're looking at, which, by the way, is when you're renting out your property by the night, in some areas by the hour, if you know what I mean. And then we're getting maximized cash flow from that. Now, the next thing we need to look about is how passive or active we want to be. Again, on that extreme, buy-to-lets, boring vanilla buy-to-let properties are as passive as it gets, whereas the service accommodation is as active as it gets. Now, can you get management companies? Yes, but it's an active income stream. And so you need to think about that. So it's how much cash flow, then how passive and active, then of course your risk tolerance. Again, lowest risk in property is your boring vanilla buy-to-lets, and would you be shocked to hear the service accommodation from a semi-passive is going to be the highest risk tolerance outside of maybe off-plan development opportunities, which we're not going there. All right. The final thing that I like to think about is the term of investment. And what I don't mean definition of investment is this. I mean, how long are you looking to invest for? So my investment term, my exit is death. Now, I know that sounds morose there, but what I mean is I'm never going to sell my properties. I am buying today, constantly, forever. And so what does that mean? It means that I don't care if the market goes up today, down tomorrow, up today, up a month, down a month. I don't give a shit. If in doubt, zoom out a little bit. Zoom out and make the long-term play. Whereas, if I'm focused on short-term, active, high-risk solutions, then I might do some developments. And by the way, I do developments. I do joint venture developments where I fund them and then we sell them at the end. I buy a property, knock down the garages and sell both off. I buy bungalows, get planning and sell the grass as a development opportunity. But my long-term play is boring, vanilla, buy-to-let properties. Within that, how do I want to make my money? Well, because I'm not obsessed with the cash flow, which is, in property, it's like every passive investment. If it's a passive investment, the cash flow is going to be low. Same as if you buy a stock in something, a share in something, the higher the quality of the company, the lower the dividend they pay out, because there's lower risk associated. And the same with property is true. The better the property, typically, I'd need to assess each one, of course, the better the investment, the lower the actual cash flow is going to be. So for those that are genuinely serious investors, you're going to be looking at something called, what I've dubbed, combined returns, also known as IRR, the internal rate of return, which factors in cash flow, capital growth, and of course leverage, which is adopted through your property investment. Before we go into what that should look like, I also think you should take account of how much money you are putting in. For example, if I've got my investment pot and I'm fully exposed to one investment, now subject to the amount you've got, which I'll go through in a second, then I'm going to expect a higher return. For example, if I've got £1 million pot of cash just sat there ready to go, then if I'm going to put that into one investment, then I want to maximize my returns in that. So if, for example, I could put that million into 50 different investments and I'm getting an 8% return, that would be okay. Whereas if I'm putting my million into one thing, then I might want a 12% return, just as an example. Now, when does that change? Well, if you've only got, and I say only, it's still a lot of money, so well done if you've got this. If you've only got 60K, 70K, 100K, that's going to be great to get you one or two buy-to-let properties. So you can't be picky because you don't want to break that down. Like, it would be silly to get 70 grand and break that into 10 rent-to-rents, for example. Very bad investment choice, in my opinion. However, getting one boring vanilla buy-to-let could be a really solid decision, dependent on the areas. How much should we be looking for? Well, for me, I wouldn't dependent on how much you've got, go less than 10% combined return. How does this work? Well, what we're looking at is this kind of an ROCE, return on capital employed. The reason I look at ROCE over yield is because that's a factual return on your investment. So if I had my 100 grand in the bank getting 5% interest, we all know I'm going to get 5 grand a year, right? Happy days. But I want to know, actually, if I took it out of that bank and put it into the property, what's my return on capital employed going to be? Now, this is really important because most people, when you go ROCE, they think just about the cash flow. But the cash flow, believe it or not, only represents 20% of your wealth over time. What? And that 20% is taxable. What about the other 80%? Well, that's where the leverage and capital growth comes in. So capital growth is partly inflation, the value of everything goes up, the cost of everything goes up, therefore property prices go up. But also in the UK, supply versus demand. There's more demand in the UK, has been fairly consistently, will be, well, probably will be forever. And so because there's too much demand on the available supply, the pressure builds up and property prices and rental prices, sorry renters, also goes up through time. And so if all of this big capital growth factors in 80%, then why aren't we taking account of it? And this is where combined returns comes into play. Now, for me, I would rather suffer more on the 20% and maximize the 80%. But the trick is, how do you find the properties that maximize that 80%? Now, the cool thing is, with that capital growth aspect of it, it makes up 80% of your wealth through time. So this doesn't matter to you if you're looking to sell the properties in the next 2 or 3 years, right? It's not going to be worthwhile. However, if like me, your exit is death, and let's assume you've got 10 years in you, well, the average property in the UK historically doubles every 10 to 12 years. Select areas, obviously, within that, and some areas way more. So imagine your capital growth doubling every 10 years. That's what we're looking at in the UK. Now, that's been happening for almost 1,000 years. That doesn't guarantee the future, but pretty good indication, I would say. How do we find these high value areas? How do we analyze them? Well, that's where we come in. Now, to go into that would be 45 minutes in itself, and maybe I could do a video, but actually I thought what would be really cool around that is offering some one-to-one strategy sessions. Now, the benefit for you will be, it's completely free, by the way, but I can add some value, my team can add some value, helping you understand what makes a great area, what makes a great investment. Why is it good for me? Why would I do that? Well, the selfish part of me is if you've got 100K, and this is only if you've got 100K to invest, by the way, otherwise we won't be able to facilitate this. If at the end of the call we feel we can help you, then we will present an opportunity to you, talk about the fees involved in how we can actually build this portfolio for you. So if you're interested in that, put APG in the comments. It's only if you've got 100 grand or more to invest in property. APG in the comments, or we'll put a link in the notes and we'll pin the comments at the top for you. So click on the link, fill in your details, and we'll go from there. Now, if you've got any value from this at all, if you could take 2 seconds of your time, just hit that like button, means a lot to me. And if you're new to the channel, or maybe you're just watching a few videos but you're not a subscriber yet, it's how we actually assess, was this a really valuable video for you? So if you've got 2 seconds, hit subscribe, the notification bell, and of course I'll see you in the next video.